All right, guys, welcome to tonight's JJ Zoom networking call. My name is Brian Fine. I am not JJ, but we'll see if we can't help you out a little tonight with some pretty valuable information. We're going to be talking about rental property and how we specifically underwrite it up front for its risk. So we'll be looking at that both as how we look at it as a lending company when we're considering making a loan, when you guys come to us asking if we will fund your rental project. And then I have a couple hundred rentals of my own. So I'll give you the very jaded buy and hold investor take on it as well. So let's dive right in. Let's talk a little bit about rental property. Let's get into it. So last week when I spoke here, we talked about construction stuff. This week, it's all about buy and hold assets. So the first thing with buy and hold assets across the board, if you all want to write this down, the once in a lifetime deal happens every week. There is no special magical unicorn deal that if you pass on, you will not get another swing at something really similar to it in the very short term. Don't ever try to act on scarcity in this business. You will fail if you do. All right. So don't be like, oh, I have to get back to them on their counter to my offer really fast. No. When we look at a buy and hold, even more so than when we're looking at fix and flip type projects or ground up construction, we're talking about assets that we plan on holding 5, 10, 20, 50 years. So this is a long-term commitment. You're getting married to this property. When we're looking at it initially, I'm looking for all the reasons to say no and pass on it. I am not looking at it with optimism of how much money I'm going to make. I'm looking at it in every single way it's going to screw me over. It's like getting married to somebody after knowing them for a week. The divorce is going to be epic. So look for all the reasons to not do it. Now, the very first way to underwrite one of these things, we can do it in shorthand. It makes it really easy. I only need to know 3 things to be able to underwrite a rental property. I need to know where it is, because the class of the neighborhood and the type of property has to match the kind of thing I'm looking for. I have to know how much it brings in rent, and then I have to know its expenses. Now, I'm going to give you guys a shortcut for the expenses. If it's a single family house, you use 40% or whatever they tell you if it's more. So it's 40% or higher. If they tell you the expenses are 20%, you're going to use 40. For a multifamily, it's 55 or higher, 55%. Here's what makes up the expenses for you guys taking notes: taxes, insurance, property management, vacancy, and maintenance. 5 items. Oh, one more, utility and landscaping costs. In a single family, you don't really have those, but in multis, it's always there. And those items combined in a single family house should average about 40% of the gross rent. And in a multifamily, it's 55 and up. So if a property rents for $1,000 a month, it makes $12,000 a year in gross rent. If that's a single family property, I'm going to take off 40% of that number immediately. $7,200 a year is what that property makes. Okay. On a multifamily, it's a higher number. I'm going to subtract 55 off of that 100. So I got 45 left. So 12,000 times 0.45. So if it was a multifamily instead that made 12,000 a year, what kind of net operating income would I get on that? Give me that number.
5,400.
There you go. $5,400. The only difference between these two properties is their expense type. It's important that you guys get this math because rentals are all about the expenses. It doesn't matter what kind of rental. A self-storage place runs about a 55% expense ratio. An RV park is about 70, right? This can vary a little. You have to look at the underlying, but those are higher. So you need to know the expenses of the asset class you're dealing with.
So the RV parks, that's basically like it's got a lot of overhead, right? It's not like the full
Yeah,
time.
it's mostly management is where
Yeah.
you end up seeing it. To see numbers like I just described, you'd have to own it for a couple of years and basically backdate your accounting to figure out how much you're actually paying in expenses. Because it won't be straightforward stuff like I cut a check for the insurance or I cut a check for the taxes. Those are easy. It's the hidden stuff. How much did it cost me to chase down the people who didn't pay me this month? How many hours did that take? Convert those to dollars. Those are all expenses. How much additional maintenance was caused, all that sort of stuff. And by the time you get into it, you can essentially do a post-mortem on owning them for a few years and figure out the expense ratios. This is a shortcut. So for single family, 40. For multi, use 55. If the actual data they give you is higher than that, it is very possible to have a single family that has a 45, 50% expense ratio. You can have a multi-family that's running in the 60s fairly easy. That's fine, use a higher number. But when they show you a number that's half that, use my number because it's a hell of a lot closer to the truth. All right, now the next number we care about is what we're gonna have to buy it for. So we know what it rents for, we know our expenses, now we gotta buy it for something. When you figure out the net operating income, we can decide what to buy it for based on the cap rate. So let's use the same kind of example we were just using. Let's pretend it's a single family house. It rents for $1,000 a month. So we have our same 40% expenses on this house. If I said I wanted to buy that house at a 7 cap, or actually I'll make the math really easy for you, a 7.2 cap, how much would you pay for the house? You guys know this? Know how to calculate it? Well, let's start at the top. We make $12,000 a year. Out of that $12,000, we lose 40% to our expenses before we even get it started. What's our net operating income? Somebody tell me.
$7,200.
We got $7,200 a year coming out of this property. What do I need to buy that property for so that $7,200 is 7.2% of my investment?
What's the time frame?
1 year.
60%.
The 60% is the remaining income that you calculated. So you're making, after expenses, $7,200. Now, how much do I have to buy this property for so that $7,200 is 7.2% of my investment? Just move the decimal point, 100,000. Because if I paid $100,000 for the property and it made $7,200 a year, that's 7.2% of 100,000, right? Does that make sense? That's a 7.2 cap. Does everybody get how I did that? Now you can do it with calculators and spreadsheets and all that other stuff and get way more complicated numbers. But this is, you'll hear this occasionally called the 1% rule. And so whatever the annual income is, divided by 100 is the cap rate at $100,000. Then just shift around zeros until it makes sense. So you can use multiples of it. So you can take the net operating income, whatever that number is, and at $100,000, that number divided by 100 is the cap rate. So if I make $8,000 a year, it's divided by 1,000. If I make $8,000 a year, if I bought that property for $100,000, that's an 8% cap rate. If I make $10,000 a year, it's a 10% cap rate. Everybody get it? At the purchase price of $100,000. It's the most basic form of return on investment. Capital return. Depending on your asset class, there's an expected cap rate. As long as something falls within this expected cap rate, we know it's not weird. For single family cash flowing assets, I expect a cap rate between 6 and 8%. For multifamily, it's 5 to 7. Just a point lower for multi. Doesn't matter how big this is. This could be $10, $20 million or a $50,000 shack somewhere. The math is done exactly the same way. We're going to do the same math on a self-storage facility, a short-term rental, a RV park. I know you guys like your pad splits. I despise them, but you do the math the same way. The 1% rule, very simply, says you take the gross rent, whatever the rent number is, and multiply it by 100, and that's what you should buy the property for. That's sort of, kind of, maybe almost okay, in that it gets you somewhere in the 7 cap range or 6 cap range for a single family house. But you got to watch using it on multifamily because the expenses are higher. So if I have a 50% cap rate, 100 times rent is actually a 5 cap because I lose half of that rent immediately. So if we ignored all expenses, the so-called 1% rule, property is worth 100 times gross rent. That's a 10 cap. It's a 10 gross cap rate. And then you would subtract off the expenses from that, which would reduce the number. Does that make sense? I'm talking about
yes.
I'm talking about the same three numbers, just like a dozen different ways you can go at it. It's all the same thing. What cap rate tells us, and the reason we want this number, and it's the one you want to calculate in your head, is it tells you whether you are looking at something that could be a deal or not. And I want it specifically within a range. So if I'm looking at a single family cash flowing asset, I expect it to be bought between a 6 and an 8 cap. And here's the assumptions I have if I get between a 6 and an 8 cap. It's in a decent area. So we're not talking about a low end type neighborhood. It's going to be in mostly turnkey condition. No significant value add, no significant deferred maintenance. It's move-in ready. And there's nothing particularly right or wrong about the property. It's a middle of the road, boring asset, the most common type of rental asset you will buy. If I see a cap rate lower than that, so I want to see a range in 6 to 8. If I run the numbers and I'm coming up with a 4 or 5 cap, then one of two things is true. Either it's in a higher end area. You're looking at B plus type areas, maybe A, or you're about to pay way too much. And if the cap rate is higher, this is the one that burns investors all the time. And this is a lesson coming from me losing a lot of money. So this is a very expensive thing to share with you guys. High cap rates are red flags. It means something's wrong. The property either is in a shit location or it needs some work. Most of the time, my experience, it's both. No one is going to sell you a turnkey ready, beautiful single family home in white picket fence suburbia at a 14 cap. Doesn't happen. They'd be out of their minds. Something is wrong if you see that. Does that make sense to everybody? So same math with your multifamily. Only thing that changes between the asset classes, whatever assets you're into are fine. It's just you got to know the expense ratio. You have to know what it takes to run these assets. So we start with the cap rate. Once we have a cap rate we are happy with, it appears that this thing can work. Then and only then do you move on to, well, what happens if we put a mortgage on it? Because if you had a low cap rate to begin with, financing is only going to make it worse. It's going to take a marginal or bad deal and put it underwater. If you have a solid cap rate, then a mortgage or financial leverage will help you keep a lot of your money out of the deal and allow you to magnify and grow your portfolio, which is the real purpose of using it. So I'm not saying never buy a property with a high cap rate. I'm just saying that it's a red flag to me. I have a lot of questions. Why is the cap rate higher?
What should your cap rate be after debt service?
Cap rate is, as a metric, doesn't include debt service at all.
Okay.
It's not factored in. It's a separate number. It assumes all cash.
Yeah.
We use different metrics when you have leverage. So here, you guys are all taking notes, I hope. You're probably about to learn something. Let me give you 2 new words. The words are positive and negative leverage. To be able to figure out which one you're dealing with, you have to know the underlying cap rate. So we had to start with cap rate before we can have this conversation. If the financing cost, the interest you're paying on your borrowed money, is lower than the cap rate, then that is positive leverage. If the interest is higher than the cap rate, then that is negative leverage. Here's what that translates to. If you're in a positive leverage situation, which is basically what the entire market was in 2020 and early 2021 before Jerome Powell ruined our fund, then the more money you borrow, the higher your returns. Because in essence, if I have something that's an 8% cap rate and I'm borrowing my money at 5%, then I'm getting that arbitrage in a difference on that investment. And I'm essentially printing money out of thin air. It's a beautiful thing. And so to the question that was just asked a minute ago, what's a cap rate for with financing? It's called a cash on cash return. Of the money you have in the deal, what is the percentage return you're getting annually on that money? Cash on cash return. If we are in a positive leverage situation, if I have an 8% cap rate on my asset and I'm borrowing my money at, let's say 5%, back in the good old days, then the more money I borrow, 80, 90% of that purchase price, of the money I have left in the deal, the higher my cash on cash return will be. because I get all the returns for that difference between that 5% and that 8%. That's positive leverage. Positive leverage is borrow as much money as you can possibly get. Assuming you can control the rest of the risk profile, please don't quote me on that directly. There's other factors. Negative leverage is the reality of today and likely the reality for the next year or three. And that is where the interest rates are higher than the cap rate you're dealing with. That means the more money you borrow, the lower your cash on cash return, because you're making up that difference in interest rate. Now, there's nothing wrong with negative leverage. These are not stop and go signs. Oh, there's negative leverage. I'm not borrowing any money. That's silly. That's not what we do at all. But it does put a very clear limit on how much you will be borrowing on each transaction. Because if you go over that number, you're in the red. Okay? Write this down. This is really important. You cannot fake equity. Can't be done. I did a little math with my partners before doing this call today. Since 2020, I've lost $2.75 million. I made a little more than that, so it's not all bad news. But almost all of that was because we tried to fake equity. We tried to turn deals into something they were not. And that is what cost us money. So if there is a lesson for you guys to be had here, don't try to make a deal out of nothing. We have an expected range for these things to operate in, and we don't want them to operate outside it. That's all red flags to me. You guys want to hear about the biggest one? The most painful part of that? All right. This is a whole bunch of deals, not just one. You can't just screw up one thing. You got to screw them all up. That way you know. Right? All right. The biggest loss we took was on a 22-unit portfolio that we bought in Pittsburgh. And when we bought it, the appraiser came in with a valuation of $2.9 million. My initial take was that the assets were worth closer to 2.4. But that was, at the time, that was like manna from heaven. Like, sweet, I got another $500,000 in equity here, even though I actually knew that I didn't. I just took the appraiser's word for it. Sounds great. And so we borrowed an extra $500,000 on those assets. And we used them to do the flip and everything else. Well, the world shifted on us. Jerome Powell started jacking up the interest rates. And 6 months later, money cost double what it did when I bought that. And I bought it on a bridge loan with no intention of keeping it. We were going to flip that portfolio to another buy and hold investor. Well, all the buy and hold investors dried up because for some reason, nobody wanted to buy at a 1% cash on cash return. And I ended up getting a new appraisal. I was being forced to refinance the asset. I didn't have a choice. I had to go to a long-term lender to do it because I couldn't sell it. And when that new appraisal came in, after I'd fixed it and put a couple $100,000 into it, it came in at 2.4 million. So I got to lose by bringing to closing the entire difference. And the major thing is I knew that on day one. And I'd have got away with it too if it wasn't for that pesky Federal Reserve, right? That just, to put myself in that position was just stupid. Royally stupid. Didn't see that at the time. I'd been batting 1,000 for the last, probably since 2016. I never lost. Everything was working great until suddenly the market that I never cared about before really mattered. And I had allowed myself to get over leveraged. I faked equity and then I burned for it.
So if you'd stuck with the appraisal, you would have been safe.
If I had stuck with my original comp package,
okay,
and not borrowed more than than that appraisal came in at, if I'd have just gone with my numbers, you go with a lower number. That's how it's really easy, guys. If you think the property's worth 100 grand and the appraiser says it's worth 150, then I suggest you stick with 100. You will not be sad. You can always sell it for the 150 later and make more money if they're right and you're wrong. If you think it's worth 200 grand and they tell you it's worth 100, it's worth 100. So it's the lower number every time. That's how we primarily go around not faking equity. Don't do it, because the day you're wrong, you will get to pay for it. So I know you guys, a lot of you are in sub 2. I know you guys love your creative subject to transactions. These rules don't change. If you're looking at an asset, let's say you're looking at a property that you need to buy at a 6 to 8 cap to be happy, and they're going to just sign the thing over to you. You can take it subject to the existing mortgage and it's all yours. Congratulations, you just got a house for nothing. But the underlying mortgage versus your rent and your expenses makes it a 4 cap. You are at substantial negative leverage and you're losing money. And after you apply your expenses and everything, you will be writing a check to hold that property because you simply paid too much for it. You can't fake the equity. Does everybody understand that?
Yeah, it's essentially like running a business. It's got to have a certain percentage, your overhead and your cost of goods, and yeah.
Mm-hmm. Mm-hmm. A business it can be looked at the same way as a rental. There's no difference. The business is just a tenant that produces X amount in rent, has an underlying expenses, and there's a return on investment on the other side. This goes for everything. It's a income producing asset. It doesn't really matter what particular form that vehicle takes. Anything that we can put money into and gain returns out of has a cap rate. And that is how you can compare completely different investment vehicles. Does this make sense to everybody? So now let's talk about normal versus abnormal versus, what's a deal, what isn't. So since we understand cap rates now, cap rates apply to every investment type there is. And generally, pretty much a law of nature, risk and reward are the same thing. The higher the returns, the higher the chances of shit happening, and you're not going to get those returns. And the reverse is true as well. If I have the world's safest investment, there's hardly any chance that I'm not going to get paid, then those returns are going to reflect that. So let's talk about zero risk. There's basically no such thing, but the closest thing to zero risk there actually is. And what we define as zero reward. So what is widely considered the safest investment on the planet is the US government's 10-year treasury. It's a 10-year treasury bond. They run between 3 and 4% interest rate for the last couple of years. I didn't bother looking it up completely, but I don't think they've failed to pay on those since their inception, which will be slightly less than 250 years. I'm not sure when the government issued the first one. So it's a pretty good track record they have. The returns are basically trash, but they will always be there pretty much every time. So on my little risk reward scale, that's the bottom of the list, the very safest and lowest return I would ever look at. One step above that, slightly more risky, a little bit of volatility there, is the S&P 500. Another thing that's been around a pretty long time and has a great track record of turning off returns. Those returns, it varies depending on the years or whatever, but it's fairly safe to put them in the 5 to 7% range. So given that these two investment vehicles are there for you and for anybody who has money, you don't have to be a special snowflake. You don't need a lot of money to do it. You can go buy a savings bond for like $100, right? You can invest in the S&P 500 for, I don't know, whatever the smallest amount a Robinhood account costs. I'm not really a stock guy, but it's not a lot of money. It's a bare fraction of what it takes to get into even the smallest real estate deal. Those are your no risk options. So everything we look at in real estate should, as a baseline, outperform that. Does that make good sense to everybody? Because if it doesn't, then just go buy the safe thing and don't worry about it again. You're good, right? It's madness to take what amounts to a higher risk and not get a return to go with it. Now here's where it gets a little funny. Your S&P 500, your savings bonds, those are real simple cap rates, right? 3, 4%, maybe 5, whatever, just a cap rate. But when we talk about buy and hold real estate, this is any real estate you hold longer than 1 tax year, 12 months or more, we don't have just the cash flow. That's one stream of income. We have 5 of them. So you got 4 more that you can convert to dollars and add to the effective cap rate. So if you guys want to write these down, here's all the different streams of income you get. This is from buy and hold real estate. I don't care what kind. It's all the same shit. Stream 1 is your cash flow. That's the one we talked about so far. That's the first one you should look at. Stream 2, the assets appreciate. So they gain in value over time, like a growth stock. Stream 3, depreciation. And while that sounds like the opposite of appreciation, it's actually a tax thing. You get tax losses that we can use to not pay income taxes on the money we're making. It can be a beautiful thing. You can convert that and figure out, I get X amount of tax losses and that translates to X amount of dollars not given to the government, and I get to keep that money in my pocket. That is effectively additional income. Third one is the most predictable of all. It's the easiest one to calculate. That is principal pay down on your debt. When you get a 30-year fixed mortgage, you can just bring up an amortization calculator and see how much less you're going to owe on that mortgage every year. A lot of your money, especially for the first few years, goes to interest, but every payment you make is knocking a couple of shekels off of that core principal, which will eventually drop to zero in 30 years. That's what that schedule means. So that difference, even if you just held it for a year, that's a little bit of extra equity. That pay down is income. We won't access that income until we refinance or sell the property, but it is a return. The last one is the rent increase. That's the most valuable one. When we initially buy a property, 80 to 95 cents of every dollar in rent you collect will go to expenses and debt service. But when you increase the rent on a property, about 80 cents of every dollar goes in your pocket. The increased rent is worth about 5 times as much as the core rent. You guys understand that? When I buy a property, I don't care what the rent is. For every dollar of rent I collect, 85 to 95 cents of every one of those dollars is going to go to expenses and debt service. That's how we bought it. Had all the expenses come out, and then we took a mortgage, and out of that money we had left, we're making mortgage payments now. So there's very, very little left for us when we're done, unless you made a big down payment. But when we raise the rent, the expenses don't go up that much. They don't increase with it. The mortgage doesn't get bigger every year. So now, out of that, every dollar of rent I increase, there are a few things I have to pay for. I have to pay for the property management is usually a percentage of rent collected. So it's 10. So immediately they get 10 cents of every dollar that I raise the rent. And then usually your taxes and insurance go up a little bit too. Small percentages, not necessarily annually. So you add a little bit for that. So let's just, for the sake of argument, call it another 10 cents to make it easy. And that leaves us 80 cents of every dollar of increased rent goes in your pocket. You guys get that? Make sense? Why I do not care what the property rents for, but I very much care what I can increase the rent to. Now, if you go off of the assumption that you own this property, when I underwrite one to buy, we underwrite for 5 years of ownership. I usually want to keep them longer than that, but I do a 60-month pro forma. I take 5 years of conservative appreciation based on the market trend and whatever market I'm operating in. How much more percentage-wise do I think this property will be worth than the day I bought it? And you use the same kind of data to figure out about how much you'll be increasing the rent over that time. And then I can take all of that, translate it into dollars, and figure out how much money I'm going to make in the next 5 years by owning this property. And then you just divide it evenly year over year, and divide by 5. And that is your return on investment, sometimes called your internal rate of return. These words are used in different ways, so don't get too caught up on the term for it. But it is the total amount you'd make. Usually when I do the math on my own, that number is over 20%. So if I'm getting 20% per year for 5 years, how much of my investment do I get back on year 5? Well, it's 20 times 5, 100, right? After 5 years, every dime I put into that property, I got back. And now I'm at what we call infinite return. That's how I do the math on my own ownership of assets. 5 years before it's really mine. Does that make sense to you guys? Give me a boom in the chat if you just learned something. Dom, I see you got a question.
What do you like for estimating what the single family should be renting for? I mean, are the rent-a-meters and the different, are those platforms pretty accurate? Because I've tried to do it by hand by searching other properties.
Yep. Mm-hmm. So there's 3 methods. We'll go from the least accurate to the most accurate. I do use and like Rent-O-Meter. And my number, if the asset's vacant, because otherwise I'm just going to use what the least number is 90% of the median. That's a lender rule, by the way. That's how we do it. So if it says median rent's $1,000 and the asset's vacant, then we will underwrite to $900. Again, this is another one of those things where you want to be pessimistic. The lower end is better. You're totally cool if you can rent your $900 a month property for $1,000. The opposite is not cool. If we thought we could rent it for $1,000 and the only thing I can do is put somebody in there for $900 a month, so now I get to bleed $20 a month until hell freezes over, yeah, that's less attractive. You're not going to like that as much. All right, so Rent-O-Meter is your least accurate, but again, generally works. It's not a bad answer. It's usually my initial answer. Second thing is the appraisal. When I do the appraisal on the asset, I will get a market rent analysis every single time. Last time I did a call on last week, I think, we talked about appraisals a lot. I do not buy property for myself without an appraisal. Hard pass, I don't do it. I used to. I have about 100 properties on one street. I know all the comps. I own them. But today I insist on appraisal on absolutely everything, because there is no upside to me buying a property that wasn't appraised well. None. The $1,000 or so it costs for the report is a joke compared to the amount of money I stand to lose if it goes wrong. So appraisal is number 2. And number 3, typically the most accurate, is what your leasing agent tells you they're going to rent it for. That's the one that I like the most. I can ignore the rentometers. I can ignore everything else. I call up our leasing agent and say, hey, I got one here. Here's the stats. What do you think? And they'll either already know the property and tell me what they're going to rent it for, or they'll go out and take a look and let me know in a day or 2. That's the number I'm going to go off of.
So okay. Property management, boots on the ground.
Yep. Who's the leasing agent? They're the one who has to actually do it. So why not go with them? An important thing for you guys to consider. This is a big fraud thing. This has also cost me a lot of money. Learned this one the hard way too. Just because a unit is rented doesn't mean it rents for that. So we have seen scenarios. I actually had it. It's fraud, but it is a thing that happens where a landlord looking to fire sell their property and get out of it will go get a tenant to sign a shiny new lease at a much higher number. And then they'll get them to pay a month or so of that rent. And then that's enough to get it through what is typically our underwriting. And so then a month or 2 after we own the property, either that tenant moves out or stops paying. And you find yourself in a situation where on turnover, you cannot rent the property for that dollar amount. It's just not possible. It's silly. We've also seen legitimate versions of this. I bought a property once that was renting for $2,400 a month. It was a doctor who was in town for something, and I bought the property based on that $2,400 a month. Well, about a little less than a year goes by, they move out, end of their lease, no problem, and I go to rent the place, and we ended up renting it for $1,600 because that was the market rent, right? And so I got eaten alive on that property. That really sucked. So even if a property is tenanted up, I'm going to use my rental fair market analysis as part of my appraisal, and the lowest number is the number I'm going to go off of. So whether it's rentometer telling me it's lower, whether it's the appraiser telling me it's lower, whether it's the actual lease is lower, or whether my leasing agent tells me it's lower, whatever the lowest of all those numbers are, that's the number I underwrite off of and assume I can rent the place for. Does that help, Dom?
Perfect. Thank you.
Awesome. Now, guys, when you behave this way, if you listen to the things I'm saying, you're going to pass on a lot of deals. You're going to think that you got a great one, and they're going to be like, you're out of your mind for what you want to buy this. And they're going to call you names. Actually, most of the time, they're just going to ghost you. And I promise that's the way you want it, because these things are awesome when they work. And they're absolutely horrible, stress-creating monsters when they don't work. And the primary reason they don't work is you didn't buy them right, or you didn't know what they were when you bought them. It's not the real estate it fails. It's your perception of what it was. If you're taking your notes, you probably want to get a new page and do 2 columns. For one of these columns, label it investor. You can put in parentheses afterwards, you. The other column, label it lender. A huge confusion that you will see from that you guys can get from the guru on whatever stage you paid to listen to is that they typically share the perspective of the lender as far as underwriting goes, and not so much the investor. So I'm going to give you both. You can side by side them. Okay, so first, and this is going to be for your expenses. It's all about expenses. First expense is property management. To a lender, property management is 10% of gross rent. To you as an investor, it's 14%. That's for single and multifamily residential. If you get into short-term rentals, the cohabitation, that kind of stuff, those things are all management nightmares. Jack that number up. Try 25, 30. Some of the better Airbnb management companies are at 50%. Okay. Now, this number as a metric is worth talking about for a moment. You can talk management companies, and some of them will even offer their services at under 10%. I've seen as low as 6, but more commonly you'll see it at 8 or 9. As an investor, or as a lender rather, I couldn't care less. I'm going to use 10 unless they have it at 11 or 12, and then we'll use that instead. I'm going to use 10 every time. You as an investor, you're going to pay the 14. Now you can choose how you pay it. You can pay the 10% market standard plus the 1-month lease up fee, plus the lease renewal fees, and a couple other little admin fees they'll chuck in there that end up being about 14%. Or you can talk down their main management rate to 7, 8%, whatever you can get them down to. You can still pay the lease up fee. You can still pay the lease renewal fees. And then you can pay all the extra little fees that will be incurred because they don't have the man hours or give enough of a shit about you to give a good experience that will cost you 14, possibly more percent. Does that make sense to everybody? This is less economics and more human nature, right? So when we underwrite your asset, I'm going to underwrite it at 10. That's market standard. That's what their headline number is. That's what they're charging you. That is what I'm pretending they're charging you, and that's how it's going to be. For yourself, 14. That is going to be the true cost when you're all said and done. All right, next one up is maintenance. How much does it cost to keep these things livable? This does very little on the investor side, or on the lender side rather, but 5 to 8%, most commonly 5 is what we use for this. If the assets are older, you trend up towards 8.
And that's for the lender or for as the investor?
That's the lender, how the lender looks at it. All right, as an investor, you get to live in reality. Reality, based off the last couple times I did this, is that a tenant moves out every 24 months. And when a tenant moves out after 24 months, they do an average of $5,000 in damage to your asset after you've recovered whatever you can out of them. So this is beyond security deposits or insurances or whatever else. $5K in asshole tenant tax every time somebody moves out. This means that for your rent reserve, or for your maintenance reserve, you need $2,500 a year per unit, or 5%, whichever's higher. It's a pretty straightforward story, right? Doesn't sound made up.
So you're saying if they live there 3 years, that one tenant's going to cost me $7,500 to repair it? You said $2,500 a year.
I'm giving you a straight average across the last 300 or so turnovers I've done. So some of them have been there for 20 years, and we move out and it's a full $15,000, $20,000 reno on the place. Others were there 6 months and cost us 2 G's, right? Like it's just a straight average, which is the best we're going to do. Straight average, right? So if I need $5,000 every 2 years, I need $2,500 a year or more. And so I use 5% of the rent or $2,500, whichever one of those is the higher number. Make sense to everybody? It costs just as much to hang drywall in a ghetto as it does in a Class A neighborhood. So not really much of a difference there. Labor's labor. Second part is vacancy. So we did our maintenance. Now we can keep the place habitable. Now we got to pay for when anybody decides not to habitate it. All right, so let's continue with our little narrative. Every 2 years, they move out, and we got to spend $5,000 making this place pretty again. So when they move out, I need 30 days to pretty it up. Got to give my guys a month to get in there and do the turnover. I mean, we always try to get them faster, but it's going to be a month. And then my leasing agent needs another month to find the next person who's going to live there. For any of you guys who own a large amount of rental property and deal with leasing agents, you know how incredibly optimistic what I just said is. 30 days to fill a vacancy? Oh, if it's only that good. But we'll underwrite to it anyway. We got to keep a little optimism in this thing. So that makes really simple math. 2 months hard-coded vacancy every 24 months is 1 month of vacancy a year. Vacancy is 1 month's rent. Whatever the number is, whatever the percentage is, I don't care. It's 1 month's rent. And I'll use that for every asset I have. Taxes and insurance are just a thing. They cost what they cost. Go figure it out. A thing to keep in mind about taxes in whatever market or state you are working in is you want to understand how those assets are assessed for property tax valuation. In some states, Texas comes to mind, they actually have their shit together pretty good. They do an annual assessment, and every year your taxes are going to go up some amount. which really sucks if you happen to live there and pay that, but it's extremely predictable. So you can just put it in that every year my taxes go up X%, and you can pro forma that out and figure out what it has to be. That also means that your rent is going up by more than that every year, because this is a direct pass-through expense to the tenant, not to us. Insurance. Nobody thinks insurance gets cheaper, right? While you hold a mortgage, you are required to have insurance that satisfies your lender. Now, it'd be an entirely separate call for me to talk about why I would never own a property free and clear, but for those of you who want to do it, I imagine that if you owned a property free and clear and it burned to ashes, you would want to be compensated for that. So if you intend to pay a property down below about 55% leverage, I would strongly suggest over-insuring. Make it so that what should be a really bad day is actually a payday, because as investors, most of the time we will not rebuild the asset. We'll just sell the ashes to somebody who cares and go buy another one. And that's what makes up your expense. Oh, the other one, utilities. Utilities and landscaping. Don't let me forget these. We're almost at Halloween. Are you guys okay with a horror story? On a very, very spooky quarter, about 3 years ago, some very good friends of mine who are absolutely not stupid went ahead and bought a 400-unit complex in Nevada. And all the numbers were good. They did all their underwriting right. They did not make any mistakes that we could see at the time. There were no issues. The place was at like 96% occupancy too. It was a full turnkey, really well managed, like good assets, no problem. All of the leases were full market rent, plus they were above that by a few $100s because they included utilities across the board for every unit. So the landlord paid all the utilities, but they charged more for it. Then the electric and gas bills tripled, and all those leases were outstanding and had to be, and they couldn't change them. They couldn't suddenly stop paying the utilities or bill it back to the tenants or anything, because the leases said they didn't have to for 12 to 24 months, depending on the lease structure. So they went from making money to significantly cash flow negative. I think they were losing pretty close to $100,000 a month. That burned through the reserves in about 3 or 4 months. And they ended up going bankrupt and losing everything. Moral of this horror story: don't pay other people's electric bill. We don't want to pay any utilities. Those costs have to be passed through to the tenant. You can do it with, depending on your state laws, the construction of your building, if it's a multifamily and all that stuff. Single family, super easy. You just don't pay for shit and make them pay for everything. World's easiest answer. In multifamily, you're going to need to have things individually metered or use RUBS, or there's different mechanisms to get there. But at the end of the day, the tenants have to be paying their energy bills.
So what happened to that building?
It was foreclosed on by the first position.
They started over?
I don't know what the first did with it. I presumably auctioned it to get back their capital at a significant haircut, because suddenly the expense ratio went from about 50% to about 80. That would do it. If you guys follow the news or just like trends in our society in general, I've talked a little bit about AI. That's basically the new nuclear arms race. And it's powered by these giant multi-billion-dollar data centers. And the most important thing to know about these things is they take a lot of electricity, a whole bunch of it. The conservative estimate is to power AI the way they intend to use it, we need 4 times the electricity we have today. So I think you can all take that as enough of a sign that your electric bill probably is not going to get cheaper anytime soon. So don't be responsible for paying anybody else's. You may not like it. Utilities and landscaping are also why a single family asset dollar per dollar outperforms a multifamily every time, no matter what. And that starts at even a duplex. It doesn't matter how big, because you have common areas and you have landscaping. All right, those costs are always there every single time. So when lenders underwrite your baseline expense ratio, that's your maintenance, taxes, and or maintenance, vacancy, and management. For most residential asset classes, we're using 20%, 10% for management, 5% for vacancy, 5% for maintenance. If you compare that to what you should be using, it's quite a bit higher, isn't it? Can anybody tell me why the lender does this? Do you think the lenders are dumb enough to not know what your real expenses are?
They want to make sure they're getting their money back.
They do. They do. So why don't they care?
You mean why they're a little bit lower on the numbers?
Yeah.
Well, they still want to try and lend the money out, I guess, to get you caught so you can get the property back foreclosed on, I guess.
No real lender ever wants the property back. That's a nightmare scenario. If I wanted your property, I'd have bought it. I did not need your help and to jump through a bunch of hoops to do it. So,
right.
No, but you're on the right track. You're on the right track. There is a thing, real lenders, not like random private people, real lenders have to deploy money. They need to do it because it's sitting in a bank account and they're losing, and that doesn't work at all. So it's got to go out there and work. So that is part of the truth. But why don't they care? Because protecting that money is the entire name of the business. So if I know your expenses are actually 5-10% higher than we're underwriting to, why would I do that? We're not that stupid. Why don't we care, guys?
You're going to ask for them to have some skin in the game?
You got it. You have equity in the deal, which means your equity is my cushion. I can afford your expenses to be higher because I have 25% equity in the asset the day I leverage it. As an investor, you're the 25%. You're in second position to yourself. So you want to underwrite to a tighter standard than your lender does. Keep yourself safe. Does that make good sense? All right. I think that about ends my rant for the evening on buy and hold stuff. I got a couple of minutes left. If you guys have any questions, we can see about getting those answered.
I'm good. It was nice seeing everybody tonight, and I'll be jumping on more of these with JJ and Brian and all you guys. I got to get my kids ready to go to bed on East Coast time. So I appreciate all your time, Brian.
Yeah, sure thing, Nick. See you on the next call.
Hey, Brian, we connected a few weeks ago. Mike Connors here. So
hey, Mike.
To see you on here. Enjoyed the presentation of what I could hear. I was driving most of the time, so I was actually on my phone. Now I'm on my desktop. But do you underwrite land commercial deals?
For ground up, yes. Horizontal is tougher.
Okay, because there was an appraisal done on a land deal that I just got handed to me recently, and they're looking to find a gap lender.
Mm-hmm.
I found a way to see if they'd be interested in trying to double close and then morph that into also a seller carryback, which works for this deal because they bought it for like around 600 and something, and the appraisal said it's worth 2.2.
Okay.
So okay. I just want to make sure that the appraisal's right. It's a nationwide appraisal company.
So what happens when you go to any lender who's worth a damn is that they're going to ignore your appraisal altogether and order a new one.
Okay.
And standard loan to value on dirt is 50%.
Well, I think this lender that they're going through ordered this appraisal anyway.
Okay. Then cool. That's what they'll base it off of.
Yeah, I believe it's from them anyway.
Yeah. So now if it's a ground up construction loan, that's an entirely different story. Like that I can do quite easy. And okay. So we would order a new appraisal, and the appraisal would be based on, they would value the dirt as it sits, and they would also value the structure you're about to put on it. Okay. And then we would get into that. And you can, ground up is an interesting animal. It's primarily based on experience more than anything else. We can do them at zero experience. But if you have a ton of equity in a project and have a little bit of experience, you can kind of emulate pretty close to 100% financing. You can get to the point where they'll basically cut you a check for the land you already own. Mm-hmm. And that's enough to get started on the ground up, and you can roll that chunk the whole way through the reimbursement to complete the construction project. Okay. And so that gets kind of attractive. Ground up is actually pretty cool. If you're doing that. But if the intention is not to build on it, then yeah, it's 50% LTV is where they all sit.
Well, they're looking for a developer to develop it, and then they were just going to buy and hold it and
mm-hmm. have
a developer come in and put some things on it and then resell it later at some point. So
Yep, exactly. If it's got enough equity, that's the big key, right? Can't fake the equity. If the equity's there, sure, play with it. Figure out how to make it work.
Another tip, I guess, that I have for you, and I wanted to see if you've tried this or see if it works. I've heard this, but I haven't rented out properties in quite a number of years. And right now, I'm not in the. I think we talked about this when we connected, if you remember. But I'm not interested in being a landlord right now. But maybe at some point in the future. But I have another guy that I follow once in a while, and he actually puts a UCC1 clause in his contracts. So if people tear up the property, he'll put a credit freeze on them until they make it right financially.
Mm-hmm.
You know, like when they move out and stuff. Because I heard you talking about that earlier.
Yeah. Do you know the term judgment proof?
No.
We consider tenants to be about 99% of all tenants are judgment proof. Meaning you can take them to court, get a money judgment for any amount of money, and they'll stay broke the rest of their lives rather than pay you. It's not worth the effort to get the paper, much less try to collect on it. So we don't bother. We underwrite to dealing with tenants as 100% loss.
What about filing a UCC1 on them?
They don't care. FICO score doesn't matter to them. None of it matters. Garnishing wages, they'll stay unemployed.
Okay.
So yeah, you can do all that. It all works on paper. Our experience with it is they're broke and it's not worth it.
Yeah.
You can get those debts, and a lot of times you can sell them to collection agencies for 5 to 10 cents on the dollar. Collect some tiny amount of money in exchange for getting the judgment, and they'll go after them and see if they can't do it. But yeah, to actually get a payment out of a tenant, not really. No. Okay. Not a thing that myself or anybody that I know who operates at scale does successfully.
Right. All right. Thanks, Brian.
Sure thing. Any other questions on this stuff, guys? All right. So on your, you got your paper with your investor side, lender side. Lender side, if you're buying a single family property for long-term rental, you're going to get a 30-year fixed mortgage, and you can get up to 80% of the purchase price. Investor side, you get a 30-year fixed mortgage, do it at 70%. When I started doing this in 2012 and kind of up through about 2023, my attitude was the less money I have in a project, the better. Let's use somebody else's money. I don't care if it's a private lender, the seller, an equity partner. I don't care. I just don't want my money in the deal. That was my attitude for years and years and years. COVID made me see the light. I absolutely want my equity that I fully control in every project. It's either mine or that of a trusted money partner. And I'll give you a very simple reason why. When you're not being paid, either because the evening news is telling everybody they don't have to pay their rent because eviction court's closed, or because life happens and tenants don't pay, it's uncomfortable to find the money to pay your senior debt partner. You got to go make that mortgage payment no matter what. That sucks. But you should have reserves to do it. But then there's a second phone call that needs made, and that's to whoever holds the equity. If it's you just have a little heart-to-heart with yourself that life sucks and you'll win in the long term, and you move on with your day. If you borrow that money from somebody else, then you get to call them and tell them they will not be getting a payment. In fact, their money is in jeopardy for a whole slew of reasons that may or may not be out of your control. And once you've had to make that call a few times, you will be very, very comfortable putting down 30% on any rental asset you buy. That's how I came to that place. I never want to have that phone call again. It sucks. And I paid everybody, but I hate making the phone call. So it's worth putting my own money down every time. And long term, you just do a lot better that way. You really do. Better cash flow, safer position. For multifamily, you can get up to 75% on a 25-year. In some cases, you can get a 30, but right down to 25, you'll feel better. Investor side, same 25-year, 65% loan to value is what you're going to get. That's the number you want. You want an even larger equity cushion. That's the way to do this that long term makes you the most money and has you take the least losses and have the least stress. Now you can ignore me, and every guru on stage will tell you to ignore me. Most lenders would tell you to ignore me because we want to lend you more money because I don't give a shit ultimately because I have my equity cushion anyway. But if you'd like to succeed as an investor, I suggest you have a cushion to not pay yourself and keep everybody else paid. Otherwise, you just have to pay everybody no matter what. or you get to default. Does this make sense? Everybody talks about these things like you're going to make unlimited money. And you will. Seriously. This is like the greatest wealth vehicle there is. But please don't be so naive as to think it's easy. Or to think that shit doesn't happen. That they break, that you don't get paid, that stuff goes sideways is part of the business model. Account for it screwing up and win anyway. And you will be super happy all day. If you're counting on everything going right, well, then your hair might look like mine in a couple of years. Thus endeth the rental sermon. Question from Mike, do we do gap funding? I will do gap funding and potentially take an equity position to a borrower who has done 10 or more loans with us successfully. It will not be a conversation until we've successfully done quite a bit of business with them. We have a couple of people we have done business that long with, and so we'll take those positions upon request. But unless we have a lot of experience with you, no. No, extremely high risk to us. Any other questions tonight, guys? All right. If you check out that haves and wants list, should have a list of hopefully you all filled it out. You can look at all the people on there and their contact information. And use that. I suggest you pick 3 people off of that list you want to give a call to over the next few days and see if you can't do some business together. JJ's all about the building the relationships and the networking, and he's right. That is super, super important. I'm more the let's write checks and get paid guy. I like that better. So I would love to discuss with any of you if you are doing any transactions, if you're trying to flip a house, build a house, do a rental, fix something and hold it, all that stuff. I want to be your first position lender. Call me. Let's talk. Let me get you sorted out. So I have money and need people with deals who want to borrow it. All right, guys, I hope you learned a lot tonight about how we take a look at rental assets, what the expenses look like, and what the risk profile looks like on these things. Ultimately, there is a ton of money to be made. It's one of the most wonderful wealth vehicles in existence. Just understand that it comes with built-in risks, and we have to control them and underwrite to them up front. Thanks, and we'll see you on the next call.